In this video, we're going to talk about profitability ratios, one of the most important tools used in financial analysis. Profitability ratios help us answer a simple question: how good is a company at making profit? Investors, managers, banks, and analysts all use these ratios to understand whether a business is performing well or poorly. Profitability ratios measure business performance, show efficiency, help investors compare companies. A company can have very high revenue but still be poorly managed. For example, imagine two companies that both sell £1 million worth of products. One company earns £200,000 profit. Another earns only £20,000. Even though their sales are the same, their profitability is very different. Profitability ratios help us identify these differences. In this lecture, we'll focus on 5 key profitability ratios: gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Together, they give us a clear picture of how efficiently a company generates profit. Let's start with gross profit margin. This ratio shows how much profit a company makes after covering production costs. The formula is gross profit divided by revenue. Let's look at an example. Suppose a company sells products worth £500,000. The cost of producing those products is £300,000. The gross profit is therefore £200,000. When we divide £200,000 by £500,000, we get a gross profit margin of 40%. This means that for every £1 of sales, the company keeps 40 pence after production costs. Next, we have the operating profit margin. This ratio goes one step further than gross margin. It includes operating expenses such as salaries, marketing, and administrative costs. If the company has £80,000 operating profit from £500,000 sales, the operating margin is 16%. That means the company keeps 16 pence from every £1 of sales after operating expenses. The net profit margin shows the final profitability after all costs, taxes, and interest. In our example, the company earns £50,000 net profit from £500,000 revenue. That gives us a net margin of 10%. This means that after all expenses, the company keeps 10 pence from every £1 of sales. Return on assets measures how efficiently the company uses its assets to generate profit. If a company earns £50,000 profit and owns £400,000 in assets, its return on assets is 12.5%. In simple terms, every £1 invested in assets produces 12.5 pence of profit. Return on equity measures how well the company uses shareholders' money. If shareholders invested £200,000 and the company generated £50,000 profit, the return is 25%. Investors often pay close attention to return on equity because it shows how effectively their capital is being used. One very important rule in financial analysis: never analyze ratios in isolation. A ratio only becomes meaningful when we compare it with previous years, competitors, or industry averages. For example, a 10% margin may be excellent in supermarkets but very poor in software companies. Profitability ratios help us understand whether a business is successful at generating profit. They show us how efficiently the company operates and how well it uses its resources.